So guess what just came in the mail this morning? It's our new book, Advanced Taxation, a book that is based on the ICAG syllabus for students writing Principle of Taxation in Level 2 and Advanced Taxation in Level 3. I'm very much excited about this book because it is based on the ICAG syllabus, strictly based on the ICAG syllabus, and also based on the new laws, the new acts, new regulations that governs taxation in Ghana as required by the revised syllabus of the Institute of Chartered Accountants, Ghana. I'm very much excited about this copy that has been released, published in the UK less than a month ago, and everything about this book is superb. It's going to be assisting you, be your master guide in order for you to prepare well for your examination. And guess what? It is just 120 Ghana cedis. And so we are going to be starting delivery immediately for the people who pre-ordered the book, because we had a lot of students pre-ordering the book prior to its release due to the pandemic. But hey, it's now going to be available. And so you can call or WhatsApp 050-114-9296. 050-114-9296 and grab your copy of this book, because I know that it's going to be assisting you if you're a follower of my work. Simplicity in detail is something that I do, and that is something that is critical, and I know this book is going to assist you in order for you to prepare well for your examination. Now, so somebody may be asking, hey Nhyira, what are some of the things you covered? You can see that displayed on your screen, but we covered the Ghana tax system, tax administration in Ghana, fiscal policy, capital allowance, corporate tax liabilities, withholding tax, chargeable income or chargeable gains, the 3-tier Ghana National Pension Scheme, income tax liabilities on natural resources, petroleum operations, mineral and mining operations, standard tax planning, sundry tax issues, professional conduct in relation to taxation, and any other thing that you need in order for you to prepare well for your examination. So what are you waiting for? Call the number 050-114-9296 and grab a copy today for your examination. I know this can assist you to prepare well for your examination. See ya. Hi everyone. So welcome to the stream today. Very much excited for having you. It's the part 3 of our discussion on the consolidated financial statement. In case you missed the part 1 and the part 2, I'm going to drop it in the description, so you can check the description to this video and you're going to see the part 1 and the part 2 of this video in the series as we conclude on our discussion towards the key principles in consolidated financial statement. And you know what we do always? If you join the stream, try to smash the like button. That way we get more engagement on the video, and YouTube and Facebook will be able to push the video so we can reach as many students as possible. Also, put in the chat box any questions that you have for me, anything you want me to share my thought on, put it in the chat box. I want to hear from you. Let me know as well how you are preparing towards the ICA November 2020 examination. Let me know how is your preparation so far. What subjects are you preparing to write? How are you gauging your preparation? Do you think you are in the right mindset, mind frame? You are in the right state to be able to register the exams, and most importantly, pass the exams when we have barely about 3 weeks to go in order for us to put in the effort and do what it is that we need to do in order for us to pass the examination. So welcome to the live stream. I see some of you guys coming on with a thumbs up on the video as well as comment in the chat box. So smash the like button. Let me see. Smash the like button for us, and let's get the discussion going as we look at our discussion for today. I see some comments coming in from Facebook as well as from YouTube. Let's pick some of them real quick. Ernest Chekudo said, it's good to be here. You are welcome, Ernest. I see Nanaya Kwek said, thank you very much for your wonderful work. It's always a pleasure. Nanaya Kweku. Nana Atrem said, good evening, Nhyira. How are you, please? I'm flourishing. I'm doing well. Nana Atrem, I hope you are also doing well. Thank you guys for the thumbs up. Thank you guys for the support and the shares. Now, remember, if you have a colleague or some friends who are writing financial reporting and corporate reporting. Remember, consolidated financial statement is one of the fundamental topics that we got to be expecting in the exam hall. So just click the share button and then share the video with them on your platforms, on your Facebook pages, on your WhatsApp pages, and let's get the video getting into as many students as possible so we can together assist a lot of students preparing for their examination. As always, my objective is to be able to hold your hand, assist you, provide you with the content and assistance that you need in order for you to pass the examination. So smash the like button. Let's get going. In case you've not subscribed to the channel also, remember to subscribe to the channel, become a VIP member, but most importantly, remember to click the bell notification icon. That way, when I release new content or I go live, you will be the first person to be notified by YouTube, so you can join the stream and be part of it and be able to prepare for the examination. So let's get into our discussion today. We're looking at, this is part 3 in the series we are covering on consolidated financial statements, both for financial reporting level 2, corporate reporting level 3, advanced financial reporting, SBR, strategic business reporting, and F7, ACCA F7, and other courses relating to financial reporting. And we want to focus our attention today and discuss a number of the issues that we have to build on. So far, in case you missed the part 1 and part 2, we saw the overview of the issue in relation to what consolidated financial statement is. We discussed what a parent is, a subsidiary is, what control is, what significant influence is. We came to the issue in relation to how an entity can obtain control. We discussed a number of ways through which we can obtain control. Then we came to the issue about the fact that when it comes to consolidated financial statement, there are, among other things, 5 steps that we're going to be following. Number 1, we determine the group structure, and you saw the way we designed the group structure, both for the simple group in the level 2 financial reporting, FR in that case, and then for level 3 corporate reporting, the complex group structure, and most importantly, how you calculate the non-controlling interest in the subsidiary. From there, we came to the issue in relation to how we can deal with investment in associates as per IAS 28, investment in associates and joint venture arrangement. And we said when it comes to investment in associates, we're going to be looking at the issue in relation to the equity method. So we're going to use the equity method to account for investment in associates and joint venture. And you saw how we dealt with the equity method in discussing the issue about the cost of the investment, bringing in share of profit or loss, deducting any dividend that had been received, any impairment on our investment in associate, and also bringing in the issue in relation to what we have to look at about the carrying amount. So today we want to build on, after we look at the net assets in the subsidiary, we want to find out how we can calculate the goodwill, most important area there. There are a lot of things that I'm going to be sharing with you there today. Then after we look at the goodwill, we're going to look at how we deal with the non-controlling interest, the group retained earnings, and most importantly, we'll be looking at the intra-group trading and how we cancel out the various intra-group trading as we put the pieces together in relation to that. So I see some of you guys also joining. Welcome to the stream. This is the part 3 of our discussion on consolidated financial statement. In case you missed the part 1 and 2, you can check the description of this video. You will see the part 1 and 2 there, so that when you watch this part 3, you'll be able to understand everything going on so far in that case. And I see some comments coming in there. Isaac Ajiman said, good evening, sir. Good evening, Isaac Ajiman. I hope you're doing well. Nana Atram said, long time joining your stream, but I have watched all benefited video. God bless you, sir. Amen. And God bless you too, Nana Atram. Henry said, good evening, Nhyira. It's good to be here once again listening to you. That is awesome, Henry. You are welcome to the stream. Benis Marfo said, good evening, Nhyira. God bless you for your hard work. Amen. Benis, God bless you as well for staying with us and also being part of the NP family. It's always a pleasure coming your way. So let's move on to our discussion real quick. If you join the stream, smash the like button for us. That is all we ask of you. That way we get more engagement on the video, and YouTube will send the video to others so others can watch, and together we can reach as many students as possible. And most importantly, help other people to pass the exams and take their lives to the next level. That is my objective, not just passing the exams, but being able to take your life to the next level so we can make the world a better place together. Right, so let's get into our discussion, Goodwill. All right, so that would be what? Like working 3 or step 3, I guess. Step 1 was the group structure. Step 2 was the net asset. Group structure. Step 2 was investment in associate. Step 3 was the net asset. So step 4, Goodwill. So we're going to look at the Goodwill, how we calculate Goodwill in consolidated financial statement. Am I out of frame? Let's see if I can bring that down a little bit. Yep. So Goodwill. Okay, so let's go. Goodwill. Now, I see a comment coming in from Lindell Kenyi. Said, if I don't mention your name right, forgive me, okay? Lindy, let me just stay with that. Good evening, sir. I'm going to be leaving the class now to watch the part 1 and 2 first. You are greatly appreciated. Okay, so you want to go watch the part 1 and 2 before you come back. Right, that is okay. Thank you very much for being part of the family. Now, when it comes to consolidated financial statement, one of the areas that the examiner would always ask you something about is the computation of goodwill, because the examiner reserves 4 to 5 marks on the calculation of goodwill. So whether you are doing the consolidated profit or loss and other comprehensive income, or the consolidated statement of financial position, or the consolidated cash flow statement for the level 3 students, the examiner is always going to find you a way to be able to calculate the goodwill. So this will be computed whether you are preparing the P&L or the position or the cash flow statement. So how do we deal with the goodwill? You see, what happens at the end of the day is that the idea about goodwill is simply the difference between how much we paid as compared to the net assets of the company. So for instance, if how much we paid for the business, okay, how much we paid for the business. So let's say to us, that is the purchases cost. I'm going to use the right word, consideration transfer, okay? So if the consideration for the business, okay, is greater than the net assets of the business, that means that at the date of acquisition, okay, that means that the difference is going to be what? Goodwill, okay? Because you see, somebody has been running his business all this while, and you want the person to give you the business the way it is? No. So if the net asset of the business is, say, $200 million, the person selling the business will say, hey, I'm going to charge you, let's say, $242 million. So that the difference to the one selling becomes a profit, but you, the one buying, that becomes what? Goodwill. So goodwill is simply the difference between the consideration transfer and the net assets of the subsidiary as at the date of the acquisition. But please note that when it comes to goodwill, we can have positive goodwill and then negative goodwill. In other words, our goodwill figure can be positive and goodwill figure can be negative. Please stay with me carefully as we begin to introduce you some key principles in here. Now, when the goodwill is positive, that is what we desire, or that is what we expect on the average. In that case, it will be recorded on the face of the statement of financial position, okay? On the face of the statement of financial position. However, when the goodwill is negative, it means that the acquisition is resulting into profit. So a negative goodwill means profit, and that will be added to group retained earnings. Did you get that? So for instance, our consideration will say $200 million, but then the net asset of the company is, let's say, how much? $245 million. It means that they have literally dashed us the company. So we're going to make profits on the acquisition of $45 million. So this $45 million becomes a profit on the acquisition, and that will be added to the group retained earnings in relation to that. So what are we saying? In a simple language, goodwill is the difference between the consideration transferred and the net asset. When goodwill is positive, which is the ideal, then that will be taken to the statement of financial position, the consolidated statement of financial position. But where goodwill is negative, then it means that it is profit, and that will be added to the group retained earnings. We good about that? Okay, so that is the KG2 understanding. I hope you get a KG2. You know, KG2 there, we make things very simple for you. But then let's contextualize everything I just said here with the pro forma on the goodwill computation. Now, stay with me carefully. I'm going to do how we calculate goodwill under the simple group structure. Then I'm going to do how we calculate goodwill on the complex group structure, all right? So you're going to stay with me very carefully on this one. So when it comes to computation of goodwill, what do? We know, so I'm doing simple group structure first. So this is for financial reporting students, the KG2 people. So let's bring the goodwill there. So what do? We're going to bring our percentage somewhere here. We're going to bring our currency somewhere here in relation to that. Remember, we are doing simple group. So let's see. More or less like my marker, it's a bit faint, but let's see. Let's go. So we bring in the fair value of consideration transfer. Fair value of consideration transfer. Now remember, in the company, we acquire less than 100%. So let's say we are using an illustration. So let's say we acquire 75%. So that's our ownership. We bring it up. Then fair value of non-controlling interest at the date of acquisition. That will be 25%. We add that up. Now stay with me carefully. It is not as simple as you think it is, because I'm going to be adding something there. So that gives us fair value of the business. Okay? Then we bring in the net assets at the date of acquisition, which is what we did in the part 2. Okay, in the part 2, remember we did a net asset of the sub. So the net asset at acquisition will be brought. And that is always subtracted. So either we're going to have goodwill or we're going to have profits on acquisition. Stay with me carefully. So like I told you here, if it is a positive figure, then that leads to a goodwill. If it is a negative figure, then that is going to be profit on acquisition. Now, if it is a profit on acquisition, what do? It means that we're going to add it to the group retained earnings, all right? But there could be impairment in goodwill. So we could bring impairment. That is, if goodwill is positive, the post-acquisition period may bring in some impairment. So if there is any impairment in goodwill, we take it out. Then we will now get a carrying amount of the goodwill, which goes to the statement of financial position, the consolidated statement of financial position. All right? So that is the pro forma for computing goodwill in financial reporting. I'm going to do corporate reporting in a moment, but stay with me very carefully. So that is how we compute goodwill. But you see, the examiner is not doing charity in the exam hall. What do I mean by that? In other words, you're not going to just jump up and get fair value of consideration transfer. You're not going to just jump and get non-controlling interest. For that reason, you may be requested to do workings for the consideration transfer. So we're going to do workings for that value. And then the NCI, we're also going to do workings for that. So when we say fair value of consideration transfer, what does it constitute? What does it include? What do we add up to get the fair value of consideration transfer? Let's look at that here. Let's look at that here. So what constitutes fair value of consideration transfer? Let's go to that. Fair value of consideration transfer. Now, please stay with me with this principle well as I unpack this up. Let's say we're working in million there in that case. I see some comments coming in. Let me look at them real quick. Benjamin Amponsa said, I was waiting for your lecture yesterday, but I couldn't but you couldn't come on. Yes, yesterday we were not able to live stream. Benny said, sir, please, can you take me through calculation on tax administration in Ghana? Take you through tax administration in Ghana. Okay, we will look at it. If it is a topic that students are looking out for, then we will be able to look at it. Nana Atrem said, please, are you done with your BOM reduction in your master class? Our master class is starting next week, Monday, and it is 250 Ghana cedis per paper. It's 250 Ghana cedis per paper. It's going to be a 3 weeks master class. You're going to have access to our online study portal, get access to all our lecture videos, ebooks, catalogs, and be able to join our Zoom sessions, and also get one-on-one session with me as I assist you to prepare for the examination. So Nana Atrem is 250 Ghana cedis per paper. You can call or WhatsApp 050-114-9296. The number scrolling below the screen, and then details will be sent to you so you can register and be part of it, right? So Nana Atrem, that is what you got to know. So let's come back to consideration transfer. Now, the consideration transferred, which is the figure you're going to be bringing up here, entails, among other things, four things. Number one is a cash consideration. Cash consideration. Cash consideration. So this is where we are told that, A acquired B paying $2.5 per share at the date of acquisition. So in that case, what do? It's a simple thing. It's a simple thing. So cash consideration, that one, we don't do anything about it. It can tell us that, the cash they paid was this amount, or they can say that they paid $2.5 per share. So you just take $2.5 and multiply it by the number of shares that they acquire. So that is cash consideration. You bring it up there in relation to that. But not only do we have cash consideration to be included in the fair value of consideration transferred, but we also have the issue in relation to contingent payments. Contingent payments. Now, stay with me carefully here. Sometimes, as part of the acquisition, the parent agrees with the subsidiary that, hey, I'm not going to be paying you today or now, but I can pay you a year from now or 2 years from now. Or I'm going to pay you some amount of money today, but I'm going to pay the rest in the future if the company goes ahead or the company turns out to become profitable. So that is what we mean by contingent payments in that case. Now, the standard states that we are supposed to discount, that future payment into present value using the parent company's cost of capital. Stay with me carefully. So we're going to find the present value of this money by discounting how much they are supposed to pay using the parent's cost of capital. Using the parent's cost of capital. Using the parent's cost of capital. If I'm emphasizing on that, you know it's very critical in relation to that. So that is contingent payments. We discount it into present terms to get a present value. The present value will be included in the determination of the consideration transferred. Now, immediately you do present value of something, you have to do what is called unwounding or unwinding. Depending on the school you attended and the teacher who taught you phonics, you have to do unwounding or unwinding. Why? Because you calculate the present value. So what is going to happen is that you're going to be calculating finance cost on that contingent payment. Okay, the finance cost on that contingent payment, and that is going to be equal to whatever present value you had there, multiplied by the company's cost of capital, the parent's cost of capital. So the figure you get, X dollars, becomes the value for the finance cost. And this finance cost, this is how you're going to go about it, will be subtracted in the group retained earnings, and then you will add it to the present value and take it to the statement of financial position. Does it make sense? That is, if at the reporting date they've still not paid it, then it has to go to the statement of financial position. I hope you got that. So that is contingent payment. You discount it into present value. The present value is what you include in the fair value of consideration transferred. Immediately you discount. Now, be careful also here. Let me say this very well. sometimes the examiner will give you the present value. So you have to listen to the English. For those of you who don't like reading, you have to make sure you read the context of the question well, because sometimes the examiner will be excited about the exams, and if he's excited, he's going to be generous. So he will give you the present value. If he gives you the present value, no need to discount again. So you just come and put the present value here. However, he will give you the cost of capital. So you can now use the present value given to you, multiplying by the parent's cost of capital to get your finance cost. So it depends. Either the examiner will give you the future value and you will discount it, or you are giving the present value and you don't discount anything again. I hope it makes sense. Let me know in the chat box if you have any questions. So aside cash consideration, which is what we pay now, contingent consideration or payment, which is what we're going to pay in the future, there is going to be another way we can finance the deal, and that is through the issue of shares, or if you want, share exchange. Share exchange. Now, stay with me carefully on this principle about share exchange because it's very critical. Now, what do we mean by share exchange? You see, sometimes the parent company will want to finance the acquisition through share exchange. What does that mean? It means that the shareholders of the subsidiary entity that we are acquiring, we're not going to give them any money, or maybe we'll give them some money. Then in addition to that, we issue new shares to them in accordance with the number of shares that we are going to be having. So what is going to be happening is that when there is a share exchange, it is the parent company issuing the shares. Stay with me carefully. When there is a share exchange, it is the parent company issuing the shares. Now, since it is the parent company issuing the shares, it means to get the value for the share exchange, we're going to be bringing the issue in relation to the number of share exchange that they had multiplied by the parent's share price. Please stay with me carefully. The share exchange here is going to be the number of shares that they are issuing multiplied by the parent's share price, because it is the parent that is issuing the shares. Does it make sense? It is the parent that is issuing the shares in relation to that. I hope you are getting the idea. That is very, very critical in relation to that. Now, how do you structure that out? So let me give you a guinea pig example here, as always, and then let's see how it goes in relation to that. So let's say that P acquires S. Let's say that they acquire 20,000 shares, and they did a share exchange of maybe 2 for 5, meaning that they will issue 2 new shares for every 5 shares acquired. So if we want the number of shares that are going to be issued, that's going to be 2 over 5 by 20,000. Okay, we give you 2 new shares for every 5. That's going to be what? 40,000 over 5. Would that be 8,000 shares? I guess so. Let me grab my calculator. So 40 over 5, yeah, good. It's going to be that. So 8,000 shares. So this 8,000 shares, okay, is the new shares the parent company is issuing. So since it's the new shares the parent company is issuing, that is what we bring here and multiply it by the parent's share price. We multiply it by the parent share price. But you've got to be careful here. You've got to be careful here. Now, if the parent is making a share exchange, what it means then is that the parent share capital will go up. And if they did the share exchange higher than the nominal value of the shares, then we're going to split that into share premium and the share capital. Stay with me carefully. You know this already from IAS 33. You know this already, that anytime a company issues shares more than the nominal value, the nominal value goes to share capital. The profits, that is the difference, goes to share premium. So where the company does a share exchange and they issue the shares at the price more than the nominal value, now you're going to bring your total here in the computation of the fair value of consideration transfer. However, that must be splitted into share capital and share premium, which then means is that on the consolidated statement of financial position, the share capital of the parent will go up. Taking into consideration the share exchange, the share capital of the company will go up. That is if they have not recorded it yet. That is another English you must make sure you understand. Because sometimes the examiner will tell you that, oh, they have recorded it already. If they have recorded it, then you don't do anything. You don't do any split. But if they say they haven't recorded it apart from the cash consideration, then after you get the value here, you must split it into share capital and share premium and add it to the parent's figure in relation to that. Any questions on that? So that is the idea about share exchange. That is the third thing. That is the third thing. Now I see some comments coming in. Let me try to respond to them real quick. James Arthur said, good work, Nhyira, big ups. Thank you. Rose said, thanks for the hard work, sir. Always a pleasure. Robert said, Nhyira, don't you think the fair value of consideration should come before goodwill so you are able to establish the cost of investment in acquiring the subsidiary to use in the goodwill computation? It is not about what should come first or what not come first. You could do this workings first before the goodwill, but I'm following a certain layout as we discussed in the part 1. That is why I'm bringing goodwill up, and then I'm doing the workings to build it up. But in the exam hall, when you are working, definitely you can't calculate goodwill if you don't have the fair value of consideration transferred. But you must know what the goodwill pro forma is, then you know the workings to be done in relation to that. So I could have brought this here, but it won't make any sense if I do fair value of consideration transfer before showing you the pro forma. So we bring in the pro forma, then we do the workings. But in the exam hall, you're definitely going to do the workings before calculating the goodwill. So that is the issue in relation to that. Malfi said, thanks for the great work you are doing, sir. It's always a pleasure, Malfi. So let's continue. So what are we doing? Fair value of consideration transfer. We brought a cash consideration, what we paid today. Cash contingent payment, what we're going to be paying in the future. Share exchange. Oh, we don't have money, so we want to give you some shares so you continue to become shareholders in the company. So we do a share exchange. Then the fourth way that the you see, this is all about how the acquisition is being financed. Okay, so under merger and acquisition, for those of you doing financial management, advanced financial management, you will learn about merger and acquisitions. Under merger and acquisition, the predator firm or the acquirer will decide how they want to finance the acquisition. So if we want to finance truly with cash today, boom, we clear it out. Or we want to finance it by paying some money in the future, boom, we buy it out. Or we want to finance with a share exchange. This is where we want to give the existing shareholders in the subsidiary to be part of a bigger firm. Are you getting the idea? So we want them to be part of a bigger firm so they will continue to have interest in the company even after they sell it. So that is the idea about share exchange. So they have sold it, but they are having a bigger interest or an interest in the group company. And the shareholders of the parent company may also not like share exchange because it may result into dilution in the earnings, okay? Dilution in the profitability of the company. But that is another way we can finance. So in order to prevent dilution in the earnings per share for the existing shareholders of the parent company, the parents will decide and say that, okay, we don't have the money now, neither will we issue shares to them so they come and dilute you guys. But hey, how about we making them creditors? So the fourth thing here is about issue of loan notes. Issue of loan notes. So this is where instead of financing the deal with cash or partly with cash, in addition, we issue loan notes to them so that our shareholders will not suffer any dilution in earnings per share. They will still be the shareholders, but then the shareholders of the company we are now acquiring will now become creditors to our company. They will become either preference shareholders or bondholders. So issue of loan notes is also another way that we can finance the acquisition. Now, depending on the way the question is structured, the loan notes can be issued in exchange of the number of shares acquired. So you have to read the blueprint very well. You got to read the statement that the examiner makes to be able to understand how the loan notes are issued. It could be that, every 1,000 shares acquired, we issue $100 nominal loan notes, okay, or $100 loan notes. So every 1,000 share, we issue $100 loan note. So if we acquired 5 million shares, then what will be the value of the loan note? So you do that working, and that's what you're going to bring here in relation to that. Now, if there is an issue of loan notes, what is going to be happening? Finance cost, okay? Because at the end of the day, we're going to pay interest on the loan note that we have issued. Hence, on that loan note, we're going to charge finance cost. Now, that finance cost will go to the group retained earnings in relation to that. So these are the 4 items that adds up together to give us the fair value of consideration transfer. So when we add this up, that is what gives us the fair value of consideration transfer. Any questions, please put it in the chat box. Any questions, put it in the chat box. Now, depending on how excited the examiner is, he can give you any of them. Maybe cash and issue of shares, or maybe 3 of them, or even all of them, depending on how excited the examiner is. So my plea to you is that you've got to make sure you understand the treatment very well for each of the items, especially the share exchange, the contingent payment, the issue of loan notes. All of these things are very critical. So that is how you deal with the fair value of consideration transferred. Okay? The fair value of consideration transferred. So we're going to snap this and post it on Instagram. So in case you are not following me on Instagram, you can follow me on Instagram at Nhyira Premium. We're going to post this. And that is where we also post the daily discussions. So you'll be able to know what we're going to be discussing for that day. Then you'll be able to join. I see some of you guys joining the stream. You are welcome. We are continuing with our discussion on consolidated financial statements. And we're looking at Goodwill. If you join the stream, smash the like button for us. That way we get more engagement on the video, and YouTube and Facebook will be able to share the video so we can reach as many students as possible. Also, if you know there are certain people who have to be on the live stream, just copy the link and then share it with them, and let's get them coming on board in that case. Cecil, Pessoa, Kwesi, Albert, Kofi, Emmanuel, Obuobi, and then Isaac Ajiman. Thank you very much for the thumbs up on Facebook. Thank you very much. And for those of you guys giving us a thumbs up on YouTube also, thank you very much for that. Right, so let's move on to the second thing. So that is how we get a fair value of consideration transferred. So let's move on to the second thing. Fair value of non-controlling interest. So how can we get the fair value of non-controlling interest? How do we do that? So let's clean this guy up, and then let's bring fair value of NCI. Remember that if the parent owns 100% of the subsidiary, then there will not be any NCI. Okay? There will not be any. First, it was called minority interest, but now we call it non-controlling interest. So if we own more than, 100% of the company, then there will not be any NCI. But where the parent owns less than 100% of the company, then the rest of the ownership will be non-controlling interest. So fair value of non-controlling interest. Now, when it comes to the fair value of non-controlling interest, it depends on the exam. There are three ways through which non-controlling interest can be valued. Three ways. So this one, we don't add them up, but one of them will be in the question. But your duty, your responsibility is to find out which one is present in the question and work with that. Okay? Your duty will be able to find out which one is present in the question, then you'll be able to deal with that in that case. So the first way that we can get non-controlling interest, the fair value of non-controlling interest, is at fair value determined by the directors at the date of acquisition. Okay? So at fair value by the directors of the parent. Now, so this will be directly stated in the question. Okay, this is where the question will say that, oh, for consolidation purposes, the directors of the parent company have decided that at the date of acquisition, the fair value of NCI should be this. So in that case, no headache, no worries. All you do is you pick that figure, boom, slot it here. So at fair value by the directors of the parent. So you don't do any workings for that. You don't do anything for that. Another way we could value non-controlling interest is also still at fair value as a proportion of the net assets at the date of acquisition. As a proportion of net assets at acquisition. So this is also another method. This is using the proportionate basis to value the NCI. Now, again, the examiner is going to be telling you what it is you are supposed to use. So this is where the examiner says something like this. For valuation purposes, the directors of the parent company determines that the NCI's, the fair value of the NCI at the date of acquisition should be their percentage of the net asset of the subsidiary. So in this case, what's going to happen is that if our group structure is like this, so if, for instance, the parent acquires a subsidiary of, say, 60%, that means NCI here is going to be 40%, isn't it? So in that case, if you are using the second method, you get the net assets of the subsidiary from the workings 2 that we did. When the net asset of the subsidiary is, say, $200,000, then you take 40% of the $200,000, and that becomes what? The fair value of the NCI at the date of acquisition, at the date of acquisition. So that's the second way. Then the third way we can value it is at fair value of the shares of NCI. So this is where we value them using the number of shares that they are having. So again, for instance, so here, you're going to value it using the subsidiary's share price. Okay, using the subsidiary's share price. So what does that mean? Let's say that the whole shares of the subsidiary is, let's say the subsidiary has a share capital of 20,000, so 200,000, that's the number of shares, and the parents acquired 175,000. It means the subsidiary owns how much? 25,000 shares. So we use these 25,000 shares to multiply the share price of the subsidiary, and that will be the value of the NCI in relation to that. So that is how we deal with the fair value of NCI. Please note that with a non-controlling interest, one of these will be present in the exam hall. So you have to read the blueprint. Sometimes it is the preamble of the question, sometimes it will be in the first note, sometimes it will be in the last note in relation to that, or within the footnotes to the question in relation to that. So you have to be on the lookout for and find out how is NCI valued. Boom, you pick it up, you take it up, then you go away in relation We good? I think we went off a little bit. This network people, they want to mess us up again. But hey, Charlie, we are back. Right, so any questions, please put it in the chat box for me. I see some comments coming in. Let's do justice to these comments. Cherom Okoto, sorry if I don't mention your name right, okay, you forgive me. Cherom Okoto said, thank you for the great service. It's a pleasure always. Bacho Fauzi said, I'm late. Assuming consideration is through share exchange, either using existing shares or issue of new shares, how will the treatment be? Do you add the value of the new shares to the stated capital already in the question? I think I've answered this question. If there is a share exchange, it depends on the question. If the examiner said they have already recorded it, you don't do anything about it. But if they have not recorded it, then you have to split the value into share capital and then share premium in relation to that. So that is how you treat this in that question. Ebenezer Side said, good evening, Nhyira. Hope you're doing very well. Yes, Ebenezer, I'm flourishing, and I hope you are also doing well. Henry Tete said, Nhyira, please, how do you calculate the level of control or group structure if the percentage acquired is not stated? Okay, it's very simple. Maybe let me illustrate that down here for you. So let's say that, for instance, the subsidiary company or entity has total shares of, let's say, 200,000, all right? So if they have 200,000 shares and we are told that that is their share capital. Now, always you have to look at the nominal value of the shares. If it is $1, it will be the same thing. But if it is 50 cents, 0.5, then you have to divide it by the value to get the number of shares. However it is, get the number of shares. So if the number of shares is 200,000, and we are told that the parent entity acquires, let's say, 165,000 shares, then what will be the percentage of ownership? Very simple. We will say the percentage of ownership will be equal to 165,000 divided by the total shares of the subsidiary, 200,000 times 100. You good? Times 100. So let's punch that out and see. 165, 200. Nope. Oh, I'm getting 82.5%. So it means that we own 82.5%. Okay? So that is how you calculate the percentage of ownership to be able to design your group structure. In this case, it means NCI will be what? 17.2. NCI will be 17.2, 17.5 in that case. Okay, 17.5 in that case. So, Henry Tete, this is how you calculate the group percentage so that you can design the group structure if you are not given or it's not stated in the question. Let me know in the chat box if you are okay with that. Right, so that is the treatment about the issue in relation to the goodwill. The goodwill. So your takeaway here is very critical. This is what I want you to take away. I want you to take away how the fair value of consideration is computed, and also make sure how you calculate the fair value of NCI. One of these methods will be coming in. Okay, remember we are not adding up. We are just picking one of them. And so based on the question, one of these guys will be in the exam or in relation to that. So that is workings 4 in that case if you are following a schedule. So let's go to the 5, and I'm going to talk about intra-group trading real quick, and then we see I introduced you to that when we're looking at the net asset of the subsidiary and also looking at the investment in associates. Remember I told you that where the associate sells to the parent, and at the end of the period the parent still has some of the things in stock, then there will be provision for realized profit. But in the context of associate, provision for realized profit, when you calculate, you will take only the percentage of the parents that they own of the subsidiary, sorry, of the associate. That's very critical there in that case. So let's look at intragroup trading and how it adds up at the end of the day in that case. So 5, intragroup trading. Now I could do this later on, but I want to just chip it in here to be able to talk about it real quick here. Senior Kewewa said, good evening, sir. Internally generated brand, is it included in the net asset of the subsidiary? It depends. If the parent recognizes it, in the question they will tell you. If the parent recognizes it, then it will be included. But if the parent does not recognize it, then it will not be included. Because you know that as per IAS 38, intangible assets, internally generated brand or internally generated goodwill cannot be included as the net assets of the company. However, on the date of acquisition, those brands will be valued by the parent. If the parent value it and deem it fit for it to be included at whatever value, then that is the value at which it will be included. But if the parent entity does not recognize it, then it will not be included in the net asset of the subsidiary. Does it make sense? So, Senior Kewawa, that is the answer to your question. So let's go to the intragroup trading and let's find out what's going on about intragroup trading. Now, I told you that whatever intragroup trading has to be cancelled at the end of the day. And remember, I told you also, I will explain to you how we will calculate the goodwill and the complex group structure for the corporate reporting students. Because what we've done here, or what we did here, is about level 2 guys, financial reporting, KG2 people. So let's come to the intragroup trading in relation to that. So when it comes to intragroup trading, I introduced this to you earlier. So it will be either they are selling goods, okay, or there's a transfer of assets. In either case, you know how to treat it already. I spoke about the transfer of assets in the introduction, so I'm not going to issue that or state that again in this case. Henry said, Nhyira, can you please illustrate the cost of investment using the issuing of loan notes approach? When you say the cost of investment using the issuing loan notes approach, what exactly do you mean? Because what we do there is that it depends on the question. So if you acquired 165,000 shares, and then you are told that the company issues $1,000 bond, okay, $1,000 bond for every 10,000 shares acquired, then you just do the math and you'll be able to get the value of the bond or the loan note that has been issued. So if they acquired 165, so if 1,000 is equal to, if 10,000 shares is equal to 1,000 bond, then 165,000 shares will be equal to what? So you multiply by 1,000, divide by 10,000, then you'll be able to get your value there. So Henry Tete, that is the answer to the question. I don't know if this is what you were asking. Let me know in the chat box if I have answered your question for you. So with intragroup trading, the way you do the treatment will be based on whether you're preparing the consolidated income statement of profit or loss or the consolidated statement of financial position. So that will guide you about how you're going to do the treatment. But in a nutshell, let's look at a number of things. Number one, if you are preparing the consolidated statement of profit or loss and other comprehensive income, this is what you do. The total sales will be cancelled. Okay? So the total intragroup sales. Okay, so if during the post-acquisition period, whatever goods that they sold will be cancelled. So how do you cancel it? It means you deduct it from revenue and you deduct it from cost of sales, meaning that double entry purposes, you're going to debit revenue, you deduct it from revenue, and then you credit cost of sales. It means you are deducting it also from cost of sales. So this is done if you are preparing the consolidated statement of financial position. Then, if for some reason any of them is having some of the goods left, then provision for realized profits comes to the picture. So for whatever value you will get for the provision for unrealized profits, that one also, double entry purposes, you're going to debit cost of sales. So you add it to cost of sales. So provision for realized profit is always added to the cost of sales. Okay? So you debit cost of sales, go and add it back. Then you subtract it from inventory. So you credit inventory with a provision for unrealized profits. You credit inventory. So the inventory is if we were preparing the consolidated statement of financial position. Okay, so if you're preparing statement of financial position, when we go to the statement of financial position, the provision for realized profit, you're going to be deducting that in relation to that. I hope you are getting the principle. So the total intra-group sales, take it from revenue, take it from cost of sales. Any provision for realized profit, add it to cost of sales, and then go and deduct it from the revenue in relation to that. Okay, in relation to that. Now, assuming the subsidiary is the one selling, then the unrealized profit will be deducted from their net assets or their profit for the year. Okay? But if the parent is the one selling, then the provision for unrealized profit will go to the group retained earnings. This is if we are supposed to prepare the consolidated statement of financial position. Okay? So group statement of financial position. So if you are doing group statement of financial position and the parent is the one selling, then PUP, provision for realized profit, will be deducted from group retained earnings. But if the subsidiary is the one selling, then the provision for realized profit will be deducted from their net asset at year end or their profit for the year in relation to that. So that is also the treatment for that aspect. But then at the end of the year, when we are preparing the statement of financial position again, there has to be current accounts. Okay, so reconciliation of the current accounts. So reconciliation of the current accounts. So I'm going to make an assumption here, and then when you flip it up, it's going to be true for the other scenario. So stay with me carefully on this one. So let's say that the parent is the one selling to the subsidiary. Okay? The parent is the one selling to the subsidiary. All right. So if the parent is the one selling to the subsidiary, and at the end of the year, it's selling on credit. Okay? So meaning that there is going to be trade payables, and there's going to be trade receivables. So if the parent is the one selling, then in the parent's book, they will have what? Receivables. But in the subsidiary's book, they will have payables. You see, when we are consolidating, we don't want anybody to owe someone, so we have to cancel any intra or inter-group amount outstanding. So how do you do that? 9 out of 10, they are not going to be the same. So how do you cause them to be the same? So for instance, in the parents' books, they think that they will be receiving, say, $10,000 from the subsidiary. But in the subsidiary's book, they think that they owe the parents, let's say, $8,000. Now, why will this be possible? Remember, I am assuming that parent is the one selling to the sub. Now, if this is like that, that means that the parent has sent some goods to the subsidiary, but the subsidiary didn't receive the goods after the reporting period. It was after until the reporting period, that's when they received the goods. So it means that there's going to be some goods in transit here, and that will be the 2,000 goods in transit. So right now, if you check it out, the account will balance, they all have 10K, 10K. Now, when you go to the consolidated financial statement, these goods in transit will be pushed to the account of the person supposed to receive it. So you just add it to the inventory on the face of the statement of financial position. However, since it is goods in transit, you have to calculate provision for realized profit on that goods in transit because they've not sold it yet. Hence, the provision for realized profit will have to be computed also on the group on the goods in transit. Now, when you go to the statement of financial position, when you go to receivables, you bring the parent receivables, the subsidiaries receivable, then you deduct the 10,000. Okay? Then when you go to trade payables, you bring the parent trade payables, you bring the subsidiaries payables, then you deduct 8,000. Why? Because in the books of the subsidiary, they owe the parent only what? 8,000. So that is the 8,000 that will go there. Then when you bring inventory, you bring the parent, you bring the sub, then you add this particular goods in transit. Are you getting the treatment very well? So that is how you deal with the reconciliation. That is the first part. Another time, still let's consider that the parent is still selling to the sub, but let's flip it over and see how it will be done in that case. So in flipping this over, check it out. We're going to flip over the idea to bring in another school of thought. So let's say that still, in the books of the parents, they know that they will be receiving $10,000, but in the book of the subsidiary, they know that they owe the parents only, how do we call it, 7,500. Why could this also be possible? It could be possible because the subsidiary might have sent some money to the parent company, but the parent company did not receive the money until after the reporting period. So what is going to happen is that is going to lead to what is called cash in transit. So with that one, we will bring it under the one supposed to receive the cash, and let's say the 2,500 will be deducted, so that now it can balance off to be 7,575. I hope you are getting the treatment. Now, if you go to the statement of financial position, you bring trade receivables, you look at the parent figure, the subsidiaries figure, then you subtract 10,000 from there, because that is the amount they are having outstanding. When you bring trade payables, the parent figure, the subsidiary figure, you subtract 7,500. That is what they have in their books. Then, when you have cash, you bring the parent's cash, the subsidiary's cash, then the cash in transit. The way we did the inventory by adding it, this one too will be added there, 2,500, to be able to get your figure in there. So that is also about the reconciliation of the current account. And this is done if you are preparing the consolidated statement of financial position or the group statement of financial position. Any questions for me, please? Any questions for me? Any questions for me? Right, so that is it about the consolidated financial statements in relation to that. So then we are left with the issue about the group retained earnings and then the non-controlling interest. But for time constraints purposes, I'm going to conclude here today. On-campus lectures will be starting in the next 15 or 20 minutes, and so gotta prepare for that, and then change up my setup for that as well in that case. So I'm going to conclude here today, and thank you very much for joining the stream. It's always a pleasure coming your way. This is the part 3 in our series for consolidated financial statements. Definitely, we're going to be continuing with it and then finding out how we can now put all the pieces together. This 3-part lectures, in case you missed the part 1 and the part 2, you can find the link in the description to this video. You see the part 1 and the part 2 in the description. So you can watch the part 1, watch the part 2, then you build it up with the part 3 to consolidate your knowledge about this topic. I see this topic always as an easy topic, even though it has a lot of principles there. If you follow it logically and you understand the treatment of the various items, you should be able to be in a better position to pass the examination in that case. So that is the issue about that, and I'm going to continue with this later on in that case. Now, Emmanuel Obuobi said, thanks, sir. You are welcome, Emmanuel. Right, so that is all about it. Thank you very much for joining the stream. It's always a pleasure coming your way in relation to that. James Arthur said, wow, today's lecture is full of great tips. Thank you, Nhyira. All right, always a pleasure. Always a pleasure. Senior Kewawa said, income tax provision, how is it treated? I spoke about provisions, liabilities in the part 2. So you can check that out. In that case, you'll be able to know how it is treated. But provisions are liabilities. So in the next asset schedule, you're going to be deducting it if they have not already done it. But if they've done it, there is no need for you to do anything about that. Right, so thank you very much for joining the stream. Continue to support the channel. In case you've not subscribed to the channel, you know what to do. Subscribe to the channel and also share the video with other people. We have over 450 videos on the channel already. So 9 out of 10 of something that you are looking for, it's already available on the channel. Just check the playlist. Look at the accounting standards. Look at the issue in relation to consolidated financial statements, group financial statements, and other topics or other playlists there, and you will be able to answer the question in relation to that. So I'll catch you same time tomorrow as we continue with our discussion. It's always a pleasure coming your way. Till we meet again tomorrow, you stay safe and you stay blessed. Bye-bye.